Go across, we're joined by Nitin Agarwal, head of BFSI Institutional Equities at MOFSL, joining us to have that very crucial conversation with regard to FCNR and how that is impacting the banking system at large. Nitin, any past precedents with regard to relaxations with regard to FCNR and any currency moves as a result of this? What could the impact of this be on deposit growth on the system at large? Give us your sense, give us your take.
Yeah, certainly. Thanks for having me. Yes, we have seen in the past when RBI, after the taper tantrum, did announce certain incentivizations for the banks, and the FCNRB deposits did see a very strong accretion ranging around $25 to $30 billion. And situation right now also, I think we can see a similar kind of increase or maybe more, though the yield difference, the rate of difference in the returns between what the Indian banks are offering or rather may offer, because there is a good possibility that banks may increase FCNRB rates in the coming weeks and versus what the prevailing rates are in US. The difference is less this time versus what it was last time. Even the US Treasury we know is ranging around 4.5% to 5% between 10-year to 30-year US Treasury bonds. And but even with a 150 to 200 basis point yield difference and the added incentives that these deposits will not attract any CRR SLR, I think there is a good incentive for banks to focus on this, raising the FCNR deposits. And therefore, we can expect a sizable chunk of FCNRB deposits to be raised, which will support the systemic deposit growth. The absolute number in terms of the outstanding deposit will still be less, but at a time when system is already priced on the deposit side, and I think this will bring in a much needed relief for the sector.
Who do you think will be oiled to take care, handle this kind of deposits? Is it the PSU banks or the private sector banks?
I think banks with a better overseas franchise are well positioned to raise FCNRB deposits. So within private banks, you will have ICICI Bank, Federal Bank, who are better placed relatively, and even Axis Bank. And amongst PSUs, certainly we have banks like State Bank, Bank of Baroda, Bank of India, who have a decent overseas franchise. And so these banks are relatively better placed to raise FCNR deposits.
And Nitin, therefore, the larger presence is what I hear is some of the PSU banks, some amount of tailwind with regard to deposits for them, but they are well placed with regard to, their loan to deposit ratios as well. Private sector banks, especially the likes of an HDFC, do you believe that they will be at a disproportionate advantage? How should cost of funds also be looked at from some of the leading private sector banks, given that their cost of funds are well below 6% or maybe even 5% sometimes? How much of a benefit does this actually entail? Give us a sense of that.
I think, banks are raising incremental TDs at around 6.5% between for the large private banks, and the mid-sized names, they have a slightly higher TD rates. So in that context, the current FCNRB rates are between 4 to 5% for most banks. That's a typical range. So if we go on to see a 150, maybe 200 basis point rise in FCNRB rates, that will still place them quite comparable to where the TD rates are. But the added advantage is that these deposits will not have any CRR SLR requirements. So to that extent, the utility of these deposits will be more, and therefore the surplus in terms of lending that the banks can do will be also a lot more. And therefore the spread that you can make from these deposits will be more than the regular deposits that the banks raise. So there will be a very marginal difference when it comes to the cost of fund. But when it comes to spread, because of the better lendability of these deposits, I think that will be more. So at the margin, I think banks will benefit out of this. And but in the incremental difference that it can create will be still relatively limited. I think the bigger point I would want to highlight is that the USD INR, the currency rate which has been under pressure, and that has been one of the reasons why there has been persistent FI selling, because besides the market-related movement, the USD INR depreciation also has stirred some bit of selling in the overall sector in the markets. And with the view that with this development, the announcement, we may see some recovery on the INR USD-NR exchange rate. And therefore, some part of FI selling may subside because of this. And that can be one of the catalysts which can drive the performance in the banking stocks over the coming months.
I get your point. Anything changes other than that structurally for you in terms of the estimates that you typically put out, target price changes? Give us a sense of that. That's the first part of my question. Second part of my question, what are your favorites in the banking pack at this point? How would you play probably the large private sector banks? I know you cover a very large area in terms of BFSI and your head of institutional equities for BFSI as a segment. But give us private sector versus PSU. What are your favorites? Small finance banks. How should one play banks in particular?
I think this development gives us a reason to continue to maintain our numbers on the growth front, because amidst all the uncertainty that is there, I think the banking system is still well poised to report a 14% CAGR on the loan growth side. And this is coming in on again, a very healthy growth that we have seen in FY26 also. So we believe that with the kind of growth that one can now see on those deposits, and that will ensure and support the lending growth also, because the lending demand is not a challenge, is what the banks tell us. And which is where we believe the growth numbers will remain healthy. And margins, we are expecting some bit improvement over FY26 levels. So we see, therefore, a lower reason to cut numbers amidst the ongoing uncertainty versus what we have seen in the past. Like in the last 3 months, we have cut our numbers by 2 to 3%, which is less of a reason now to incrementally worry about. And between the spaces, PSUs and privates, our preference has been more toward private banks, because FY27 is a year wherein the earnings growth cycle is changing. Last 4 years, we have seen PSUs growing faster than private banks. And we will therefore now want to be more selective. We like large private banks wherein the valuations have come down to very reasonable levels. And within PSUs, we are more selective and continue to like SBI and Indian Bank within our coverage.
Nitin, give me a sense of what is the kind of incremental deposits that would get added to the entire pool, because anyways, banks are struggling to get deposits, whether it's private sector or public sector. What is the kind of incremental deposit that will add on to that? And when you say that it may help in margins because of the costs being little lower, for the public sector banks which were reeling under the ECL impact, will that mitigate the entire impact, and as a result of which you have a better margin profile coming in?
I will say that, see, this incremental deposit that can come will still be around maybe 25-30. It's a very difficult guess. But $25-30 billion, if I take it at that, then that is just around between 1 to 2% of the outstanding deposits. So it's not a large number when you see in context to where the outstanding deposit base is. But from the standpoint that deposit growth has been around 9.5-10% odd on a sustained basis. So even 1 to 2% makes quite a difference to that number. And that helps relieve some bit of pressure onto the overall deposit sourcing that the system has been facing over the recent years. So to that extent, it helps. On the margins, I said the cost of fund, while the change will be very limited, but on these loans, given the lendability, that will be more because there is no SLR and CRR requirement on these deposits. That will help improve spreads at the margin. And over, therefore, FY27, our view that the banking system NIMs will be a tad better than FY26. I think that essentially holds. So in the near term, you may still see some pressure because we are still on a downward trajectory on margins across many banks. So that may continue, but over FY27, we expect that NIMs should be a marginally better than where we have been in 26.
It was a pleasure talking to you today and getting a perspective on the impact of FCNRB on Indian banks. We'll step into a small break and come back with Market Open.